But I know I believe in angels. I believe in happiness. Good evening, everybody. So I apologize. My voice is a little squeaky, a little froggy. um, it's just a little different taste for you. I'm always mixing it up, right? I cut my hair, change my voice. What's next? So I do want to start the news off definitely by saying, please go over to YouTube and subscribe. It's the Caffeinated Cooper Show channel that you can find on YouTube. And that way you're always interactive with the show. So, and it reminds you, right? Ring my bell. You're never going to miss another show. I want to give a shout out to my parents. This is a picture of my lovely parents. They are celebrating today, May 6th, 2022, is their 60th wedding anniversary. And I want to say happy anniversary to mom and dad. They were attending my nephew's debutante ball. He wasn't a debutante. He was an escort to a debutante in Spartanburg, South Carolina a few weeks ago. So this is a recent picture. And I am very thankful and very blessed to have, look at that, beautiful, wonderful genes. They both look so young as they did, and they were when they were married in 1962 on May 6th. Happy anniversary, mom and dad. So without any further ado, I'd love to bring on our financial expert, J.C. Schweingruber, and let's get into what's going on with these markets. And, it seems like we were talking in the green room, it's kind of a broken record. It's, oh man, tumultuous, like crazy, ragged. How many different words, how many different adjectives can we throw at the market?
Yeah, I mean, I could scratch my head and try to come up with adjectives and have to get out of thesaurus. But it's been, been a very crazy week. And to say the least, Monday's big sell-off, after Fridays before, and then a big rally on Wednesday because the Federal Reserve's language that they weren't going to consider 75 basis points. Then the market just roars up like, 800, 900 points, something like that. Thursday down 1,000. So I'm sure people are just like, what in the world is going on? And today it was down about 100, about 90 points or so on the Dow. Which was good. I didn't want to see a big run up. I didn't want to see a big sell off. I wanted to see some stability and get that volatility down. So Thursday, about middle of the day, when the market was, it was Thursday, middle of the day after the big sell off on Wednesday, or the rally on Wednesday and the sell off. We're right in the middle of this big bloodbath on Thursday. I go online and I just remind people that. I put this little caption at the top of this video on VistaFront Partners Facebook page. The sky is falling. The sky is falling. Not really. Yeah. So that's all the noise you hear from people. There's so much selling and nervousness in the market that this is one of those, in my opinion, rare opportunities when people should be looking to put the money to work. You always look in hindsight thinking, hey, back in 2008 and 9, when the market crashed and we thought the banking sector was going to collapse, I really wish I'd have bought some banks back then. We can always in hindsight say that. But the only thing we know for certain is that, death and taxes. And the markets are going to continue to go. We've been through stuff like this before. So when the markets are this volatile, have sold off this much, and it may continue to sell down some. But these are the times when you're going to look back 5-10 years from now thinking, man, I had another golden opportunity in my lifetime to put money to work during a time when I could have got a lot of great value. Mm-hmm. So we don't know where the bottom is, but putting a little bit in at a time and dollar cost averaging down to get a lower average cost of whatever you're investing in is a smart idea right now. Mm-hmm. I'm of the opinion that this is a buying opportunity over the next few months, whether the market is trading in a range or we still continue to see volatility. Because remember, the Fed is going to keep raising interest rates. That's still going to kind of make people nervous. They're always going to find something to complain about in the world that's going to cause a sell-off. There's always something. So just keep that in mind and approach it with patience and with a long-term approach, and you're going to be just fine.
And we have spoken about that so many times. I'm sorry. There's an offline conversation going on about my voice. I just want to give a shout out to Ken Dodge. Ken is a wonderful viewer of the show. He's been on the show so many times. You know Ken. I know Ken very well. And I just want to say thank you. Yes, I got my goodie bag of prescriptions yesterday. All right. So we have spoken so many different times about how when the market is down, not to panic, it's going to rebound, and it is the time to buy.
Right.
So tell me a little bit more about that. Maybe this is a good time to bring in a question that I had, that we were sort of talking a little bit in the green room, because I thought about him. So I know a young man. He's been working in a blue collar position for many years. And he came to me and he said, I know you've been, having JC Schweingruber on the show, and I definitely want to reach out to him because I've been putting away $50 every paycheck. I currently have $4,000 saved, and I don't know what to do with it. And I want to work something towards a retirement, but I'm not offered a 401k matching, not offered anything traditional for retirement. What could I do with that money?
Well, first of all, how old is he?
37.
Okay, so he's got plenty of time for retirement. He's got some years to accumulate money, and he's doing a great thing, a little bit out of every paycheck. Mm-hmm. So the first thing I would say to him is, good job on that. Good job on saving some money, and ready to, being willing to invest, especially in this market, because it takes some stomach and it takes patience. So as long as you're comfortable knowing that it still might go down while you're investing, the first thing you should do every paycheck, and this is for everybody, pay yourself first, because everybody else is coming for your money after that, whether it's your credit card companies that are going to be raising your rates here pretty soon, the electric bill, the car payment, the mortgage, everybody's coming for your money. Pay yourself first. They're not going to pay you when you retire. So pay yourself first. Take a little bit out and then work with the rest of that as your budget. One of the things that he could consider doing, since he has such a long time horizon, things that he's going to want to consider: how much risk is he willing to take? Does he want to put money into a mutual fund or some individual stocks that are very aggressive and growth oriented? Because the longer the time frame he has, the more ability he can do that now. So longer term, those are good strategies. But if he doesn't have the stomach for the ups and downs of the market, we find something a little bit more in the middle range, something a little bit more balanced. Maybe we leave some in cash for stability, and some in a mutual fund or a couple of individual stocks. And I want to get into mutual funds here in just a few minutes, because I know a lot of people own those. That's what most investors go to. So he definitely wants to consider his time frame, one, his risk tolerance is the second thing. One thing I love for people to do: write down, just in a few sentences or whatever, write down roughly when you think you want to retire, what you want to have at retire, and what are your goals in retirement. That doesn't mean like I want to be rich. I mean, everybody wants that. I mean, it's a simple thing to put. Do you want to retire and live where you live at? Do you want to retire somewhere else? What kind of lifestyle do you want to live? Literally think about those things. Think about those things that you want. And when you have a vision of where you want to go, then you can pull out a roadmap on how to get there. So that is a very important thing I tell investors to think about. And it's okay to be a little bit of a dreamer. We all are, right? So that's just the beautiful thing, because we can strive to meet those goals. So that's the thing he's going to do. Is he saving? And if he wants a certain type of lifestyle or goal for retirement, is saving $50 every paycheck enough, or does he need to do 75 or 100? And how is that going to impact his expenses now? Now we're in the middle of an inflationary period, so people, that don't have matching 401ks or big paychecks are living a little tighter to the belt. And so that's another thing to consider right now. Considering the market, one of the strategies I would look at, no matter what his investment he chooses, I would, if you had 4,000 to start off with, and the next few months might be volatile, Why don't you put $500 to work in a mutual fund this month? See where things are at next month and put another 500 in, and then another 500 until you're invested to the amount that you want to be invested in. And that way you're getting an average price of what's going to happen over the next few months, and not just one particular price and hope it goes up. You're shooting for a long-term investment strategy anyway, so you can actually ladder out those investments with the money that you have. So that's a consideration. I'd certainly tell him to consider that approach going through the summer, considering all the things that are going on. Whether the market goes up or goes down, it's going to go one way or the other, but we know over the long term it's going up.
So let me ask you this. So what if he wanted to retire in the next 20 years? Is it still the same advice? Would you suggest that maybe he does something a little bit more high risk?
Well, you can split it up into different types of investments. You can do part of it in very high risk, some of it in still aggressive in stocks that are maybe more conservative types of stocks, like dividend paying stocks. You could have a portion in a mutual fund or an ETF that is more aggressive with growth oriented stocks. Could be those in the technology sector, for example, and biotech, versus something that's going to be in slow and boring, steady banking and utilities, and those things are going to pay you dividends. Consumer staples type stocks. That is if you wanted all stocks. If you wanted to even get more conservative, you can look at bond funds. Not the best time to buy bonds, by the way, but again, if somebody's looking for a long term, they can certainly put some of that in fixed income mutual funds as well, and consider that strategy. And that's something he may want to. If he's married and has a spouse and they're investing together, they may want to talk together. Or if he has an advisor or wants to call me and kind of chat and kind of get an idea where he wants to go, he's welcome to do that too. I'll walk him through that, whether he does anything with me or wants to do it on his own. I'll be glad to help people just kind of because part of the conversation, I think a lot of people that may be hesitant to call an advisor. I know now a lot of advisors put a hard sell on people. They definitely want your business, but I'm as picky with clients as I would be a client would be picky with me. I want to make sure we're both a good fit. And if we are, great. If it's a waste of his money to pay a fee, then I'm not going to have him pay a fee. If he was more comfortable in an index fund, then why would you do anything like it with me? Don't waste your money. Just and that may be a conversation he needs to have to determine the best strategy for him, what's going to be the best fit, whether it's an advisor doing it on his own at a kind of a retail broker.
That's awesome advice. Thank you so much. I have your email address scrolling at the bottom. It's jc@vistafrontpartners.com, and that is how they can email you. If you have a quick question, maybe would you address a quick question, or how do you handle your email?
I just check them daily, about once a day, just to see if any clients, maybe let your potential clients have left any comments on our website to come through to me, and then I can either respond directly, or sometimes I'll just say, hey, can you give me a call? My number is, and I'm dealing with whatever situation, and then we'll do that. But yeah, I'll be glad to answer any questions through email, or just if they would rather. Sometimes email can be a little chaotic. It may take people have follow-up questions, so 5-minute phone conversation doesn't cost anybody anything, so if you'd rather chat or Zoom, just let me know.
That's awesome. So now I do want to touch behind us a moment because we don't want to focus so negatively on the market, but the market's just very shaky. It's very unstable. In your best opinion, again, I'm so sorry, I'm guilty. I watched the Johnny Depp trial again this week. So I know it's down. I know it's crazy. I know it had a wild day on Wednesday. What exactly contributed to that? Because I've also seen some more polls coming out of Quinnipiac and other places. The polls are 77%, I believe, was reported today that people are not happy with the inflation, not happy with our economy. So 77% of, generally all Americans are upset with it. So it looks like we have more aggravation of the general population for the decisions that our administration is choosing to make. But what did you see?
Well, my first question is, who are the 23% that think everything's great? That's what I want to know.
They're high school students.
I think a lot of it is the inflation numbers. Now, we had a prior conversation. This is probably going back into December and before, when we would talk on the show here, that I talked about, hey, we might already be in a recession and just not know it. All right. Well, the definition of a recession is negative growth for 2 consecutive quarters. Well, shockingly, we got a negative growth report in the first quarter.
Mm-hmm.
Well, I wasn't so shocked. I think the thing is, I'm glad that I work from where I do, and I'm not, on Wall Street exactly, because I live on Main Street, and so do you, and so is everybody watching the show. We sort of are the canary in the coal mine. We feel it coming down the pike, what's happening. And inflation really started to pinch probably a couple of months before Christmas. I mean, when people really started to feel it everywhere.
Mm-hmm.
And here we are in May, and people are pissed.
Mm-hmm.
And people have cut back on their spending. That's been seen. Some corporate earnings have blown through their numbers, and some have not, and given negative guidance. Inflation is the biggest thing right now, and the supply chain issue. Again, we've beat that horse so much, but that is the prevailing issues. And until those get resolved, people are still going to have those negative numbers in those polls.
Mm-hmm.
And they deserve them, honestly. Main Street has felt like a recession probably for all quarter. Like we sort of know it. We knew it. And now you'll see pundits all over the news now over the next few weeks, probably. They'll say, hey, we might be in a recession. Well, thanks for being late to the party. They live on Wall Street. They live in mansions. They live luxurious lives. The rest of us live on Main Street, and we sort of know this. Mm-hmm. Now, the stock market is a future-looking beast, okay? So it's sold off. It started selling. It's been volatile for a while, but it started really selling off here recently, and we're in bear market territory, over 20% down from recent highs, and it is ugly. But the market will turn and come out of a downturn like before we're out of a recession. It's because it's forward looking. So when everybody realizes, hey, we're in the doldrums of a recession, and the stock market starts going up, that means we're probably a few months of working out of that recession, And who knows, how shallow this will be, but it would honestly not surprise me if the next quarter we had another negative earnings or negative GDP. And just to solidify, hey, we're in a recession, and everybody was saying, hey, it wouldn't be till 2023. Well, okay, so the Federal Reserve was wrong about transitory inflation, and now all these so-called pundits on TV were wrong about when a recession was coming.
Right.
Like they're never right. Like we sort of feel it on Main Street, and I think that's what's really happening. As far as this particular week, today, for example, the market was so nervous that when Under Armour, the shoe company, reported, and they didn't hit their hit their expectations. Well, the market had been down a good bit earlier, and it come roaring back to it was down like 70 points. I'm like, well, hey, we're showing a bottom here. We're showing stability. People are, there's kind of trying to solidify a bottom, which is good. That's kind of what I want to see. That's why I don't like seeing huge swings.
Yeah.
If we get a few days of staying on a bottom, then that tells me that we're looking for a leg up. Well, Under Armour reports and disappoints, and next thing I know, it's not 15 minutes later, the market is down 350 points. Like, it's Under Armour, for crying out loud. Not like they're the biggest dog on the block. Why are we? And then, of course, Dick's Sporting Goods, which has a big arrangement with them to sell their products. People kind of look at that like, well, maybe they're not hitting their numbers. And anyway, but then the good news is, so people sort of freaked out, like literally right after the Under Armour report. I'm watching this live, like, really? Like people are freaking out over Under Armour. And then toward the end of the day, what happens? We're only down 90 points again. So people, you're starting to see people are like, they're dipping. There's some smart money dipping in there at some of these lows. I'm like, this value a little too good. Now, if you're nervous going forward, people are going to camp out in conservative type things, dividend payers, some. They'll be picky about them, and probably energy. That's another sector that's done, continuing to do well. But that's kind of where we're at. I mean, like little things like that. The big rally we had after it was because the Federal Reserve after they raised interest rates 50 basis points, they said, well, that 75 basis points that we talked about before is pretty much off the table. We're not going to raise that much at one meeting. And then I guess the market thought it was a sigh of relief and a big rally.
Mm-hmm.
Well, the next day, people thought better of it. Like, yeah, they still could. See, it's just fickle. When you get that kind of thinking in Wall Street and in the market, that's when if you're a long-term investor, and like I said, you got patience. Just start writing down your buy list and slowly put money to work.
I'm going to type that in here. That's great advice. Write down your buy list. I mean, that's wonderful news, wonderful advice. And, I'm looking here at some of the losses. Of course, Under Armour, that was huge and not unexpected. Some of the travel companies. So Royal Caribbean also closed down. And then oil companies, our energy sector, all of that either maintained or it closed a little up.
Mm-hmm.
That was Bank of America is down, though. Very interesting. Isn't it interesting when you look at it week by week? Look at what you're creating. I've never done this before.
Yeah, if you watch it week by week and day by day, you'll drive yourself nuts. So there are times that I have to sit down and say, listen, man, I'd stress over this 3 days in a row. We've bought good stuff. I'm not worried about it. Take a day and take a deep breath.
Yeah.
If the market's not off 800 points and I'm in there buying, why don't I just go fishing? something like that. Or go sit at the park for a couple hours, get some fresh air, and enjoy.
Breathe. Yeah, just breathe. We'll all get through it. Just breathing and being kind.
Yeah.
So looking into next week, as you're taking that deep breath, what are you expecting? Anything new or more just volatility going forward?
It's probably still volatility. That volatility index I've talked about is still high.
Yeah.
I mean, it came down a little bit today. It fluctuated a good amount this week, but there's still more corporate earnings out next week. We're in the middle of earnings season, and I always try to watch those, especially the big names, see where they're going, and then the stocks that we have for our clients and their portfolios. I'll follow those and kind of see how see which way the wind is blowing, and am I going to put a little bit to work this week or not? And so I'm not. I don't really. I'm trying not to have any crazy expectations. I'd love a calm week, but if we can get a couple of back-to-back weeks of just a little bit more calmness, I think that will probably take a lot of the nervousness out of the market. But until we get a couple of weeks like that back-to-back, any given day can spike. One thing I will mention, this is the craziest thing. There's robotic trading, algorithms that actually automatically trade stocks, not humans, but computers make that decision. They have the algorithms built in by companies. And whether it's mutual fund managers, hedge fund managers, pension fund managers. And one of the things that they look at is that 10-year yield that we talk about so much.
Yeah.
And when it's over 3%, they look at it as a nervous thing to sell. And a lot of the selling you see is just automatic, algorithmic selling. It's not a human making the decision. They've typed in their algorithms and what they're looking for, and they're sticking to that game plan. And a lot of times you see a big sell-off like that, and you're like, that makes no sense, because it probably didn't.
Wow. And that's crazy. That just seems like if there's an algorithm and they're working within a certain parameter, it seems like you'd have almost insider trading laws broken.
Well, it's heavily regulated. But it's not like they have any inside information.
Yeah.
But they may have something in there in the algorithm that says, once the 10-year yield goes over 3%, then we want to start liquidating positions in this sector at a pace.
Yeah. Mm-hmm.
And that computer will take out a percentage of each sector and then start flooding them out and selling and selling and selling until they get to a point where it triggers to stop. And
that's really interesting.
Yeah, it's like the 80s when everybody's on Wall Street, those movies, and yelling in the pit and throwing papers around and cussing each other and telling your mother jokes. It's not like that anymore. It's all.
When you catch the closing bell, though, it does look like it might still be like that, because there's a whole lot of yelling and bells and all kinds of stuff.
Oh, yeah.
And to somebody who's not used to it, such as myself, it looks very exciting. So what about that jobs report that came out? So it was about 100,000 less than what was needed or expected, I suppose, depending on which news you're watching. So 428,000 jobs in April. That doesn't sound too bad.
That's a good number.
Yeah.
It's a good number considering that was for April and given the inflation pressures but that just shows that people have to hire and wages are going up. That's putting wage pressure out there, which puts more pressure on the consumer.
Right.
But it was a strong number. It was a good number. I was glad to see it. I don't think it's going to have any bearing on how fast the Fed raises rates continuing to go forward.
Mm-hmm.
Unless we get some crazy blowout numbers and like, hey, listen, inflation's about to spike really bad and we have to do something drastic. But I don't really see anything like that happening. Actually, I wouldn't be surprised if it sort of slowed down. If we're starting into a recessionary period, we might see that slow down.
I am slightly cautious in that. It does seem, so many people left their position looking for a higher paying position, new position, this, that, the other, from that December to January, February.
Yeah.
And I don't see where the new jobs are being created right now. It seems like we shut down a lot of sectors where magnanimous amounts of jobs would be there. Amazon has already had their explosion. Granted, they're still building, they're still hiring, and that constitutes as a job. It's not just all C-level jobs, right? So I do kind of see us in that traditional August slowdown where back in the day, August was always that pre-freeze. So the hiring freeze was going to be in December because everybody's coming to the end of their budgets. They're trying to figure out their budget for the next year, and they're just not going to hire anybody in December. And then everybody's taking time off. So that never happened. But August traditionally was the month to take a vacation for companies that were European based. And that's what they used to do. It was the whole month. You never took vacation any other time of the year, month of August. So it was like a pre-freeze. I kind of see that pre-freeze coming again, not because of vacations, however, because of the consistent hostility in the market. I see employers kind of staying and employees having to stay.
Yeah.
What do you think?
And that's what's happened. I think one of the most disappointing sectors where you're not seeing the job growth that you needed to was the service sector. Because you're right, a lot of these jobs that are come online for people to change jobs in this great resignation, well, it was just the jobs that are open back up from prior. And the service sector is a big part of that. And that's actually not seen any kind of I don't know, like the spark you would hope. That's why every time you go through a drive-through now, it's slower. Going to a restaurant, it's slower. They don't have people that want to go back in and work, and you have to pay those higher wages to get them in there. And at some point, if it costs you $10 or $15, I noticed this. Like a couple of people I got to eat with on a regular basis. Now between the three of us, it costs $15 more than it did this time last fall. I mean, are we going to go out every day still? No, probably not.
No, we're not. I had to take a second guess on that because yesterday was my birthday and the kids kept asking, do you want to go out? Do you want to go out? This was before I got sick. And I thought, no, half of the kids are going to want to eat at one place. The other half are going to want to eat at another place. And we used to just go and put up with it. And now I'm like, no, I don't want to wait in the long lines. Service is slower and everything's more expensive.
Yeah. Yeah, it's true. So this Mother's Day, we are actually going to my sister Tammy's house and we're just going to cook out, I guess. Hot dogs, hamburgers, have a little fun, have a few people over and, give gifts and kind of enjoy the day that way. As much as people love going out on Mother's Day and for your birthday, but Mother's Day especially, every restaurant's going to be packed with about a third of the normal staff that should be there not being there. So can you imagine how much of a hassle that's going to be this weekend? By the way, before I forget, happy Mother's Day, all you moms out there. That's it's an awesome weekend for you, and I hope everybody has a great time.
Yes, thank you so much. I've been saying happy Mother's Day to everybody today, and it's so nice because moms just love it. So uh, that's wonderful that you're going to go out. And I think so. I think a lot of people are still definitely going to go out for those holidays and things. But I'm curious to see what happens when summer comes around. We've gotten so accustomed, especially here in the suburbs, put the kids in the summer camps. Well, that costs money. Go on vacations. That costs money, and I think it's going to be really interesting to see exactly where does the herd go because
Yeah.
they're always so indicative of what is going to happen in our market.
Yeah. And, for our region, everybody goes to Myrtle Beach for vacations. I don't know about down in Atlanta, but like around here, everyone goes to Myrtle Beach. I would love to see some of these smaller beach towns. They probably don't want that huge influx like Myrtle Beach does, but um, I look for any place except like places like that, that smaller places with a little closer, a little more charm, some live music. And it doesn't take much for me to have a vacation. But, vacation and shouldn't be a lot of hassle to get around either. And, places like that, I think are kind of, I got tired of those a long time ago. So,
Mm-hmm.
but yeah, you're right. It's often referred to as the summer doldrums when the slow in the hiring and, a lot of people just kind of check out of the stock market. Don't even trading volume actually goes down during the summers unless there's like something crazy going on. But,
Right.
and you may see that again this summer. So that's why I think we're probably likely to trade in a range on the market. And I know it sucks for balances, people that are fully invested, they have to ride this out.
Mm.
But if you have cash to put in, oh my God, this summer to me is kind of like a sweet spot. Like the last month and going through the summer, if any time to have a big influx of cash coming in and new clients, now's the time, so because not for the next few months, but the next few years, the decisions people make and how they invest will pay off the next few years. So we'll see how that goes. But one thing can I get back to your young man you were talking about that works
Of
there?
course,
Hey,
yes. Mutual funds, right?
yes. We had a discussion about what the difference was between an ETF, an exchange traded fund, and a mutual fund on a past. But I started thinking like there's so many mutual funds out there. How do people pick the right ones, and what do they look for? And there's folks like in my business, we look at these things all day long. I mean, I may be familiar with a fund that I've been familiar with for years, and over time, but if you're kind of new or doing your own research, you kind of don't really know where to start or what to look for. And that's why I said it was important for him to think about what his goal was and his risk tolerance, because you have to decide first and foremost um, what your primary goal is for the fund. Is it aggressive growth, capital appreciation, as you sometimes hear it called? If you need to have a long term need that you're investing for, something like that, and how much risk and volatility you can handle. Do you want things with more dividends, or things that with no dividends that reinvest back in the company that's more aggressive on the growth end?
Mm-hmm.
Do you want fixed income like bonds? And then what kind of bonds do you want? Or do you want a mutual fund that has a target timeline that you're investing for, and it's more aggressive early and then gets less aggressive over time? So there's all these funds out there. And when I first got in the business, there was a guy that he had been in the business probably for about 10, 15 years. And he was in the next town over. This is when I was an Edward Jones broker at the time, and had an office over in Radford, Virginia. And the guy in the next town, he said, "Listen, I'm not joking. You could just have mutual funds and just throw them on the table if they were like blocks, and you couldn't tell one apart from another.
Mm.
There's so many of them out there, and this will blow your mind. There are over 8,000 mutual funds out there right now."
Why are there so many?
Because people keep putting these things out there and people keep buying them. I mean, supply and demand. I mean, yeah, why are there so many? That's a good question. But it's been steady like that for the last 20 years, around 8,000. Now, at one point, I think it sort of peaked at, I want to say about 13, 14,000. But then that was way too many, and a lot of them weren't getting fund flows, and they consolidated, or some just performed so terribly bad. Even at big brokerage firms like Fidelity and so forth that had to consolidate funds inside with another fund that they offered just because one sucked and they didn't want to get rid of all the assets, had to go somewhere, right? So, um, So when it comes to doing your research for your fund, first of all, think about what the goal is. Okay. And there are a lot of different parameters that you can look at when you look at a mutual fund. Now, a couple of things that I like to look at is, the first thing that sticks out in the mind, a lot of investors is like, hey, does that thing have a Morningstar rating? Yeah, if it's been around at least 3 years, it'll have a Morningstar rating. So I want a fund, obviously, that's been around for a while and has a track record, because I want to see what that track record is. And I sort of lean on the side of mutual funds that either are 4 or 5 star. Now, I don't mean just this year. I want to look back over 1, 3, 5, and 10 year time frame. And I would love for it to be a 4 or 5 star fund for an entire decade. That tells me there's a lot of consistency there. So that's one of the first things I'll look for. And I'll do a little bit of risk analysis on the fund, and I'll kind of look and see, like, what are the top 10 holdings? What sectors is this in? Is these sectors are very volatile? Is this something I kind of want to be in? I've heard of Google, I've heard of Amazon, I've heard of Microsoft. All of these are in this fund, top holdings. Is that something I want to hold? So you have to ask yourself that. Or do I want steadier companies? Do I want something that's like, my power company, like American Electric Power, or like Altria Group, or maybe Nike or McDonald's, other stocks, that you're familiar with. So you have to look at those types of things and think, hey, am I comfortable with those companies? Is that something I'm okay with? Also, you have to consider your tax situation. Are you buying this in just a general account? Because it is taxable. Every year they do pay, whether you reinvest those capital gains or not. Even if you don't ever get a dime sent to you and spend it, the mutual fund will pay dividends and capital gains, and you can reinvest it back in the fund, which is the compounding. That's what you want to do. But it's still a taxable event, and it is still passed to you. So if that mutual fund paid a capital gain, well, you're paying capital gains tax whether you took anything out of that account or not, if it's a general taxable account. So that's the difference between, do I want to buy a mutual fund and knowing that I'm going to have those taxes, or do I want to buy a stock and I don't have that tax until I sell it? Mm-hmm. That's a big difference. So you have to ask yourself that. But just kind of pick up on a couple things to look at. You want to actually look at the fees that are involved in there. You want to check the class, because sometimes there's what's called a front end load on a mutual fund. So in other words, if you wanted to buy $10,000 of a fund, American Funds Group, they're one of the biggest ones out there. They used to charge for Class A shares 5.75% up front. So if you bought 10,000 of their fund, well, then you might as well knock out $575, because that's your fee to buy it. Okay. And you're buying the lesser amount. I do not like loaded funds. I tell people, avoid loaded funds. They already have expense ratios built in there. That should be the fee you pay. Don't ever pay a fee to buy a fund.
Okay.
So when you look into the expense ratios, that is actually what the fund management charges you. Now that they don't send you a bill, it just comes out of the price of the fund, because it costs money to trade in a fund and run a fund and do the research, and I get all that, but you do not want an expense ratio that's too high. As a matter of fact, I tend to look for mutual funds that have like a 0.8, 80 basis points or less, because the higher that fund, that expense, the more it eats into your return.
Okay. So
those are just a couple of things, simple things to look for as you consider your strategy. And one thing you want to, if you see something in the information when you're looking through about your mutual fund that you're considering, if you see something that says a 12B1 fee and they actually have a percentage of what you pay, a 12B1 fee is that's just a fee that a fund will charge you so that they can have an extra amount to pay for their marketing. Yes, that's legal. They can charge you, the shareholder, to pay for their marketing. If I see a 12B1 fee, that fund goes right off the table. Don't even look at it anymore. Front end load fees, off the table. Don't even look at them anymore. I look at funds where I know what I'm putting in. I'm getting the exact amount that I'm buying. I know what my expenses are. I know how the fund is constructed. I look to see who the fund managers are and how long they've been there. And if they've been there a long time, how's their track record? some just simple things to look for in a mutual fund to make sure that you're comfortable with that. And and looking at it and considering your situation, you may decide a mutual fund is not for you. You want to go for an individual stock. But again, you take a lot of risk with an individual stock as opposed to a mutual fund, because a mutual fund may have 100 stocks in it, and you diversify that risk.
Mm-hmm.
But those do fluctuate and go up and down. So don't think for 1 minute that they're not going to be as risky. You're still in the stock market. So you can own an individual stock that went up today and have a fund that went down. So it's on a day like today when the market's down, obviously a stock fund would likely be down. And then you could have an individual stock that, like in the energy sector right now, that's just blowing the doors off.
Right.
Yeah.
It really is. My goodness, there's so much. You need to like build a board game, sort of like Monopoly, call it mutual funds, because it just seems like there's so many little intricate things that you want to look for, that it just doesn't seem that it's foolproof for somebody who's untrained to go out there and try to pick their own.
Yeah, it takes time to learn how these things operate and what every little minute detail is. You're going to get in there and you'll see something like a turnover ratio. What is that? Well, that means they're buying and selling more in that portfolio. They're turning over the stocks more, like you would turn over inventory at a store.
Uh-huh.
Well, the more they're turning over inventory, the more likely they're going to have more capital gains tax you have to pay. So that's like little intricacies that you need to think of. So if you're in a rough tax situation, you probably don't want mutual funds anyway. If you're paying like top, if you're in a top tax tier and or almost in the next tier, and you don't want some sort of income, not a capital gains, but even like dividend income kicking you over, over the top to the next tier. It's like, who wants that?
Right.
Yeah. So, but yeah, things to consider. But there are places out there people can go and learn about mutual funds and what these are. You can find things online, and sometimes just a simple Google search will help. Whether you want something that's actively managed, where the fund manager's picking and choosing stocks all the time, or passively managed, which means they may pick 20 stocks and that's all they're going to hold ever. They don't change.
Mm-hmm.
And what happens if one of those goes bankrupt? Well,
right.
Yeah, you're out of luck. But so just a lot of things to consider. And, it is tough. But I don't want to make it tougher on anybody than they need to. You can find a lot of really good funds that are out there that are 4 and 5 star. Even though I don't give my playbook away, I keep a list of those that are large cap that meet my criteria, then mid cap that meet my criteria, and small cap. Small cap means small companies, and mid-sized companies, and then large companies. So in each sector, I keep those, and in each category, I keep my list of, okay, here are my preferreds. So if a client comes to me and they need some diversification, and like the gap is small cap value, well, on the Morningstar style board, then doggone it, I know where to go look for small cap value, because I already have these kind of in the hopper and ready to look at and ready to go.
So I have kind of a dreamy question for you, and I think it's probably on a lot of people's minds, especially when they're trying to plan their life. They're young, they're educated, now they're going to go out there and start working. What do rich people do with their money?
They don't waste it. It's like probably the thing that I've read the most. I'm a voracious reader, and if I can read stuff by Buffett and even things like by Grant Cardone, or like the Secrets of the Rich and Wealthy, things like that, they don't waste their money. When they invest their money, they like to buy things that give them intrinsic value. Like Warren Buffett would never buy gold, as much as you hear commercials about buying gold, buy silver, buy gold. It doesn't do anything for him. He's like, what's the intrinsic value? It's just, it fluctuates. It's not like it's property and I own it. It's not like it makes something and I get a dividend from it. It's not like it's a company that makes something useful. So, yeah, they're very picky about not wasting money. They pay themselves first, like I talked about what your colleague there was doing, putting aside each paycheck. Awesome, that is awesome. You want to be wealthy when you're you want to be wealthy when you retire. If you're young, $50 from each paycheck, you're a millionaire when you retire.
Yeah.
$50 out of each paycheck, even if you're just doing an index fund, the S&P 500 index fund, something simple. You're a millionaire when you retire. So, kid, you're 18 years old. You want to retire a millionaire? Pay yourself $50 every paycheck. Simple as that. That's the how many times do you go to Starbucks a month? Cut that in half.
Yeah.
I was go to work one extra day a week.
That is one part of the inflation that I was kind of hoping that some of my close relatives and maybe at college would start using, like their coffee machine in their dorm room or something like that, instead of going out to Starbucks, because, if they were paying, I don't know, maybe 2 years ago, they were swinging by there paying for the same coffee $3. They're now paying almost $6 for it. And, that gets expensive.
Yeah, buy a Keurig, and you can find those K-Cups that make mochaccino, cappuccino. I enjoy them out of my caffeinated Cooper coffee mug. Matter of fact, that's what I do. I don't waste money going to places like that. I mean, I'm not rich, but I'd sure like to retire rich.
Yeah.
But yeah, I mean, if you're young, you have every opportunity in the world and no limited number of excuses why you're not going to retire a millionaire. Period. Don't shoot yourself in the foot. As a matter of fact, that's why I think we need to have more financial literacy in high schools. We desperately need that.
There was a high school. Oh my goodness. I was reading something. I don't think I was watching a news broadcast, but there is a high school that has implemented a financial course as a accredited course. I'll have to find out where it is. Virginia is coming to mind. But it could be that school in Colorado that has been in the news quite a lot. There is I think it's a full cluster of schools. So they have, elementary, middle, and high school, and they're just doing their own thing. And they started doing their own thing end of 2020. They're like, no, the kids are going back. And then all the CRT stuff started coming in. They're like, no, we're not doing that. We're just, we're focusing on reading and writing and math and, our U.S. history, world history from what we've known for years and years and years, and then some. And, that's what we're going to do. But we're not going to get politics involved, is what they were trying to say. Yeah. So it may be them.
Yeah, I think, I've never heard that. Actually, I heard there was a state that was going to be updating their curriculum, so it was going to be added to all high schools, actually, in one particular state. I don't remember which state it was, but I've heard about that high school. And for all you parents out there, this is great. I saw a commercial on, it probably was Bloomberg. There's an app that's out now, and I forgot the name of the app, so you might want to just Google this, that it's a financial app to help you teach your kids basic finances from the time they're young and learning to save, so that by the time they're like teen years, they've been instilled with, just from this app and these little games that parents can play, showing them how to teach them basic investing skills, that by the time that they're teenagers, they will understand a lot of things about investing and debt management and how not to go into debt, good debt and bad debt, things like that, and savings rates. So I thought that was impressive. I thought, man, it's about time that I've seen something like that advertised, because it's needed in high schools, but if you could instill that in a child, can you imagine how much they're going to want to save when they get older?
Absolutely. While you were speaking, I typed that in really quick. And so on Kiplinger, I'm on their website right now, and Savings Spree might be one of them. It won the Parents' Choice Award for kids 7 and up. But then there's Renegade Buggies. Yeah, Buggies, Renegade Buggies, Bankaroo. There's a whole bunch of them. Green Streets, and the S is actually a money sign. Unleash the Loot. That's wonderful that they're creating those. I wonder, you'll have to look it up and let us know which one it was that you saw.
Yeah, definitely so. Definitely so. But yeah, so it's just been crazy week. But yeah, I think that would be some good advice for your colleague. And yeah, I'll be, if he needs to drop me an email, he can drop me an email. Anybody's welcome to touch base anytime. And I know it's Friday evening, and a lot of people do things on the weekend. It's Mother's Day, so enjoy your Mother's Day.
Thank you.
But I do check my emails on Saturday, so I do work with people on Saturday, sometimes via Zoom, and when they have time to talk. So yeah, just keep that in mind. So yeah, we're here to work for you. So we'll work on schedules that we need to.
That's awesome. All right. So before I let you go, just let us know, how can we get in touch with you? Is a website best? You've mentioned your email, which is conveniently scrolling at the bottom for us right now. It's jc@vistafrontpartners.com. How else?
Yeah, go to vistafrontpartners.com. There's a contact us button, so you fill out that form there, and it'll come through, and we'll contact you. And on my website there, you'll see our phone number as well, and it's on our Vistafront Partners Inc. page on Facebook too. So we have a couple of phone numbers. I put mine on the website, and so you're welcome to just dial me up, and if you don't get me, leave a message. I'll get back with you as quick as I can.
Oh, that's awesome. I love the Facebook page. You just posted a recent video on Vista Front Partners Inc., the Facebook page. So make sure that you go over to the Facebook page as well. And it's wonderful tips, and you compact everything into just a few minutes. So it's very consumable.
Yeah, if I can give like just a basic investment lesson or like a reminder in 10 minutes or 3 minutes, whatever, I'll try to do that. Try to do one about once a week. But we do post up a lot of articles up there that we think people might find interesting. So go to that page, give it a like, and follow, and we'll pop up in your thread maybe once or twice a week. We don't obviously bombard people with stuff because yeah, we're busy too. But yeah, if you need to stop on there and kind of see what's on our mind, or what feedback we're getting from our clients, or something we might want to do a video and talk about, then you'll have it right there.
That is wonderful. Well, thank you so much for coming on to the show. Please wish your mother and your sister a happy Mother's Day, and have a safe one.
I will. Happy belated birthday to you, and happy Mother's Day to all the moms out there. Hope you have a great weekend.
Thank you so much. We'll see you again soon.
Right, take care.
All right. Bye-bye. Oh, everybody, we are blessed. You are blessed. Mwah. I love you. Stay tuned for another great show coming right for you at 9 p.m. tonight. See you soon.